Okay, we're going to go ahead and get started. Good afternoon, everyone, and welcome to our webinar about the benefits of WIFIA financing. My name is Jorianne Jernberg, and I am the director of the WIFIA program. I will be your moderator for today's session. This is the second in a three-part webinar series. Okay, I'm having a little bit of problems with the slide deck, advancing it forward, so bear with me for a second. Thank you for the technical assistance. We're hosting these webinars to help prospective borrowers better understand the WIFIA program, its benefits, and its application process. Today we're going to focus on some credit and structuring requirements for the WIFIA program, and then we're going to get into a topic that I personally love to talk about, the benefits that WIFIA loans can offer. These webinars are also designed to allow EPA to interact with prospective borrowers and water industry finance professionals from around the country. Ultimately, we hope that the webinars will pave the way for successful letters of interest in response to future funding rounds. Now, to better understand who the audience is today and whether you're interested in applying for WIFIA financing, we'd like to do a quick poll. We're going to launch 3 questions. The questions will be up for about 1 minute each, and they're really designed to help us better understand the type of project you might have, the size of project, and who you are as a prospective borrower. Okay, thank you everyone for answering those poll questions. Today I'm joined by the WIFIA underwriting team. Kevin McDonald and Amit Srivastava both joined the WIFIA program last year. They bring with them a diverse background in federal lending, including experience at DOT's credit programs, as well as at XM and OPIC. We're very glad to have them, and I know that they will give you a lot of useful information today. We encourage you to write in questions throughout the presentation by typing into the question area of the GoToWebinar dashboard. Questions can be posed at any time. We'll answer them as they come up at the end, and we'll get through as many as possible. In addition to doing a Q&A today, we will also use these questions to develop a final Q&A document that we're going to share on our website. If we don't get to your question during the presentation, we may follow up with you later, or please feel free to reach out to us after this webinar. Now, before I turn it over to my colleagues, I want to talk a little bit about the WIFIA program. Just go forward one more slide. WIFIA's mission is to accelerate investment in our nation's water and wastewater infrastructure by providing long-term, low-cost, supplemental credit assistance under customized terms to credit-worthy water and wastewater projects of national and regional significance. The program was established in 2014 in the Water Resources Reform and Development Act, or WRDA. It was modeled after a similar successful program at the Department of Transportation called TIFIA. Between 2014 and 2016, EPA took the necessary steps to establish a federal credit program and basically developed the administrative framework to make loans. Seeing that, Congress appropriated funding for the program in December of 2016. That gave us the financing capacity to launch the program for FY17. We put out a notice of funding availability that was basically, we had an open period from January to April of 2017, and then we selected projects about 90 days after that funding period closed in July of 2017. WIFIA is a federal credit program, and one of the great things about federal credit programs are that they allow the government to leverage federal appropriation. Congress only needs to appropriate money to cover the estimated losses on our loans. The remainder of the funding that we ultimately lend is borrowed by EPA from the Treasury. Because the water industry overall has a low risk profile, the congressional appropriations we receive can support a much larger amount of infrastructure investment. For example, in 2017, EPA received $25 million in subsidy. This amount allowed the agency to potentially lend up to $2.3 billion in credit assistance. And because WIFIA can only fund 49% of project costs, the total infrastructure investment supported by that $25 million in appropriations could be more than $5 billion in overall project costs. In terms of programmatic status, as many of you know, the federal government is currently operating under a continuing resolution, or CR. Because of that, we don't yet know what our FY18 appropriation will be. However, we are optimistic that the program will be funded again in 2018. Both the draft House and Senate versions of the budget include funding for WIFIA at the same level as FY17, and that's $25 million in credit subsidy that could extend to, about $2.5 billion of credit assistance. Now, the last thing I want to talk about before I pass the microphone over to Kevin is to provide a quick overview of the projects that we invited to apply in 2017. We selected 12 projects, and those loans, up to $2.3 billion, will benefit more than 20 million people. The projects are spread out across the country and include new water treatment plants, combined sewer overflow abatement, water recycling, biosolids handling, eliminating ocean outfalls, and stormwater management. We selected 10 public entities, 1 corporate entity, and 1 state revolving loan fund program. Overall, the loans for selected projects range in size from $22 million to $625 million. And now I want to turn it over to Kevin McDonald, and please bear with us as we switch seats.
Thank you very much, Jorianne. I would say that for the folks out there in the ether that Jorianne is a tough act to follow. I think she'd probably sound at home on NPR. I hope I sound nearly as professional, and hopefully you will be able to learn some information about the credit terms that we are able to offer at the WIFIA credit program. So our credit terms are actually set in statute by Congress, and so when Jorianne spoke about WIRTA, WIRTA actually established the framework through which we can lend, and Congress largely borrowed from the TIFIA credit program at DOT in establishing the credit terms that we can extend to borrowers. And so I'm going to talk briefly today before I turn it over to Amit to talk about the benefits of how you can apply these credit terms to loans. So the first thing that I'm going to talk about briefly is the interest rate that borrowers will enjoy from borrowing from EPA, the maximum amount that we can lend to an individual project or collection of projects, the amount of time that we can defer payments, the maximum potential term that you can borrow from EPA, and discuss just briefly about our standards for creditworthiness that the law establishes in order to allow EPA to extend credit to you. So let's talk briefly about the interest rate that a borrower can enjoy from entering into a WIFIA loan with us. The interest rate on your loan will be established at the conclusion of the negotiation session that you will enter into if you are selected to apply after our letter of interest process. That rate is established at closing and is based on the state and local government series daily rate, which is a rate that state and local government entities can borrow from the U.S. Treasury. And so in essence, it is the cost of the U.S. Treasuries at that day. That rate does not change over the course of your loan, and for any draw that you seek to obtain cash from EPA, you will be charged at that rate. So this is actually a very powerful tool, which Amit will talk about how you can leverage. But it's important just to keep in mind that your interest rate is fixed throughout the draw period of a maximum of 5 years. In addition, I want to point out that the interest rate is established based off of something called the weighted average life of your WIFIA loan. So for most loans, even if your term is up to 35 years after substantial completion, if you are amortizing principal on that loan over the term of your loan, like you do if you were going to have a typical house mortgage, your weighted average life will be, in many cases, lower than the 35-year term. So what in essence that does is reduces the rate that you can borrow below the nominal rate. So for instance, I looked earlier this week, the 30 to 40-year Treasury rate was about 2.8%. If your term on your loan is 35 years, but the average life of your loan is in the mid-20s, like it would be on a mortgage loan, your actual rate that you enjoy will be about 2.6 something percent. It obviously is going to vary until you close the loan, but again, we think that the rate is very attractive, very competitive, and we do not charge any fees on an ongoing basis above the interest rate that you lock in at closing, other than a small servicing fee. The next thing I want to talk about is the maximum potential loan amount that you can lock in with WIFIA. And on last week's webinar, we talked briefly about the type, or more than briefly, talked in detail about the project types that are eligible for WIFIA, along with the different types of cost categories and activities that are eligible beyond our broad funding eligibilities that Jorianne alluded to earlier. It's important to note that WIFIA can fund 49% of reasonably anticipated eligible project costs. And so that means that before we execute your loan, EPA is going to ensure it understands the scope and reasonableness of the costs that you are submitting for scoping of the loan amount. So, for example, when we execute a loan, we are going to have a very good sense of your project budget, your contingencies, your financing costs, and all of the categories that we are allowed to finance. And we will set the loan amount at 49% of those costs at closing. Your loan amount will not subsequently go down if you enjoy savings from, for example, not realizing the total amount of your contingency. However, if on the flip side, if costs go up, we will not be able to increase the amount of your loan. So it sort of cuts both ways. In addition, the maximum amount of federal involvement on a project is limited to 80%. So for example, if you receive grants from the federal government for your project, those cannot exceed, plus WIFIA credit assistance or other federal dollars, 80%. It's important to note, however, that SRF loans, state revolving fund loans from either a clean water or a drinking water state revolving fund in your state, are generally not considered federal funds unless the dollars themselves come from appropriations that are received annually from Congress. In addition, the WIFIA loan may not exceed the senior obligations on an individual project in dollar amount unless the WIFIA loan obtains an investment grade rating. However, in the water space, most projects are structured so that they're very highly rated. So this clause will generally not apply unless the project is relatively aggressively structured. For maturities and payments, let's talk briefly about sort of the term that you can enjoy from WIFIA. The WIFIA loan must be fully repaid within 35 years of substantial completion of the project or the useful life of a project. So for example, if you're looking to construct a new pumping facility and you expect that generally the blended life of that pumping station will be about 40 years, the maximum amount of term you can receive from EPA is 35 years after the completion of the project. However, if you are financing a project that you think is only going to last 20 years after the project comes online, then the term of your loan may not exceed 20 years. It's important to note that the maturity date is based off of the substantial completion of the project, which the statute defines as operating in the manner through which it was intended to perform. So, for example, that pumping plant, to the extent it starts pumping, that is when EPA will define substantial completion on that project. In terms of payments, debt service must commence no later than 5 years after substantial completion of the project. And when we mean payments, we are referring to payments of principal and interest. So a project sponsor can begin paying interest immediately after they start drawing WIFIA proceeds. However, we have the flexibility to extend to borrowers the ability to defer payments of principal and interest up to 5 years after substantial completion. It's important to note that this flexibility is intended to allow project sponsors with projects whose cash flows grow over time, to the extent that you do not need sculpting. You do not need the benefit of the full 5-year deferral of principal and interest. EPA will discuss that with you and ascertain whether it's truly necessary for the completion of the project and the overall credit worthiness of the structure. Payment requirements. So our statute outlines that WIFIA must be repaid with a dedicated source of revenue. And I think that it's important to note that WIFIA has tremendous flexibility to accept various types of payments for repayment of its loan. And I'm not going to go through and call out every single potential repayment source on this chart, but it can vary from a general obligation of a municipality to water rate revenues. It can be a tax increment financing district. I think it's important to note that from a high perspective that EPA has to identify a source of revenue to repay our loan, and that cash flow can support the senior obligations along with the WIFIA loan, but we have a significant amount of flexibility on the type of stream of revenue that can be pledged to repay us. In addition, it's important to note that the pledge must be in all material respects the same pledge as this project's senior obligations. Multiple sources of revenues can be cross-collateralized into a common security pledge. So to put a little bit of a detail on that, if you are planning to have a number of small municipalities that are banding together to construct a project, those municipalities can commingle their resources together into a common revenue stream that we can then use to repay our loan and other debt on the project. The statute specifies that EPA will require security features such as a rate covenant as a part of the underwriting process, and I think it's important to note that, again, similar to our flexibility on repayment type, we have flexibility to structure what our security feature will be to the revenue stream itself. Just to finally wrap up the credit terms, deferrals, as I discussed before, need to be contemplated in the loan agreement, and they are at the discretion of EPA. So to explain that in a little bit more detail, to the extent that the project's ramp up is slower than is expected to grow over time, when we negotiate the terms of the loan agreement, that needs to be incorporated into the loan agreement. We do not have the same flexibility to extend deferrals after we execute a loan agreement. And we have to be sure that there's a reasonable likelihood that we're repaid. Prepayments, another powerful feature of WIFIA that Amit will talk about, is that we can accept prepayments at any time. So to the extent that you get a big windfall from your state or a bank settlement or wherever that cash may come from, or you just think that interest rates have changed and it's more favorable to refinance or eliminate your system or project's outstanding debt, we can accept cash payments to repay part or all of our WIFIA loan at any time. However, the one condition to that is we may not accept federal funds to prepay us. So you can't use an appropriation from Congress to prepay the WIFIA loan. Subordination, I think Amit's going to talk about this a bit more in the powers of subordination, but the WIFIA loan may be subordinate to the project's other obligations. And I think that this is he'll talk a bit more about the power of this later. But it's important to note that in the event of a bankruptcy, insolvency, or liquidation, which we define in our credit agreement, the WIFIA loan will spring to parity with other obligations that are used to fund the project. As a part of the application package, after you're invited to apply, WIFIA requires a preliminary rating letter. And this must be from a nationally recognized statistical rating organization, so Fitch, Moody's, and there's a number of DBRS. Treasury defines which entities qualify as an NRSRO, and we can accept a preliminary rating letter from any of those entities. Contents of a rating letter will typically include the proposed loan structure, what you're planning to pledge to us as a repayment stream, your likely coverage ratios for the cash flow relative to debt service, and other assumptions, both legal and credit. EPA has the flexibility to accept an existing rating letter in a case-by-case basis if the rating letter has rated the same lien structure and a security package that WIFIA will be enjoying. So to give an example, if a water system has recently gone to the market for a senior lien revenue bond and has a rating on that, and within 6 months or so is invited to apply for a WIFIA loan to support another project, EPA has the flexibility to accept that rating on a case-by-case basis, and project sponsors are encouraged to discuss that with EPA if they intend to do so. Finally, before we execute a loan agreement, we are required by statute, so we have no flexibility in this, to have 2 final rating letters, which will be public rating letters from those SROs that assess the default credit risk of the structure. It's important to note that the senior debt on the project must receive an investment grade rating or above, so that would be BBB- or better. And the rating letter must include a number of items, including the terms and conditions of the WIFIA loan, details about the structure, the security, the collateral, and in many ways, this is an update to the preliminary rating letter that incorporates the terms that EPA may negotiate with with a borrower as we work through the underwriting process. Now I'm going to turn it over to my colleague Amit Srivastava to talk about how borrowers can use these credit terms to generate benefits to their project and their stakeholders.
Thank you, Kevin. And just as a reminder to folks, feel free to ask questions. There's an orange arrow on the top right of your screen where you can click and submit your questions. So please do so if you have questions. So before we dive into the WIFIA benefits, it's very important that we understand one of WIFIA's key objectives. WIFIA does not finance, we don't finance entire projects. We provide flexible, low-cost debt to borrowers for an amount up to 49% of eligible costs. And these low financing costs and flexible terms makes the transaction more attractive to other creditors, spurring outside investment in the project to cover the remaining 51%. So the goal is not to displace debt from other creditors, but to instead encourage outside investment in the project. And as you can see, we are open to co-financing alongside numerous sources of financing: private equity, revenue bonds, corporate debt, grants. There's a large spectrum there. So WIFIA benefits can be broken down into 3 key buckets. I'll do a high-level overview, and we can get into details in subsequent slides. First, we offer cheap financing. We have a very low fixed interest rate. Additionally, our fees are lower than most other creditors. Our loan terms are flexible. Borrowers may take advantage of a flexible repayment schedule, a customized disbursement schedule. They may prepay the WIFIA debt at no additional cost. And we have seen before in the previous slide that they may seek financing from various outside investors to provide for the 51% balance of the project. We are also flexible in our lien priority. This gives lenders with higher payment priority more access to more cash, improving their coverage ratios and giving lenders more confidence that they will be repaid in a timely manner. The interest rate will be locked the day you execute the WIFIA loan agreement at financial close, and it will stay the same through the life of the loan. If you choose to have multiple disbursements, the rate at which you capitalize interest will remain the same. It will be the interest rate at financial close. As we mentioned earlier, the interest rate is equal to the U.S. Treasury rate at a similar maturity, and we only look at the weighted average life of your WIFIA loan when we compare it to a Treasury bond of similar maturity. So what this means is that a AAA rated borrower and a BBB rated borrower with the same repayment schedule can expect the same exact interest rate. As an example of what our rates may look like, we have a 30-year rate listed. On October 26th, the rate for a WIFIA loan with a weighted average life of 30 years was 2.93%, a very favorable rate. WIFIA is also very competitive when it comes to fees. In the capital markets, fees are a percentage of the loan amount usually, while WIFIA fees are based on the costs of our financial, legal, and engineering advisors. Additionally, these advisor fees may be included as eligible costs and financed by the WIFIA loan. So let's take a look at where the total fees would land for both WIFIA and capital markets debt. So for a $200 million loan, capital markets fees would be around 1 to 2% of the loan amount. So we're talking about $1 to $2 million. Now with WIFIA, we have reviewed the costs of our advisors, and we estimate fees landing in the range of around $250,000 to $350,000. So quite a significant savings. So by this time, we've talked about some key benefits of the WIFIA loan program. The low interest rate, the low fees, the ability to customize disbursements and repayments. But what does this all mean in terms of total savings for the borrower? Here we show an approximation of the savings you can expect if you incorporate WIFIA debt into your capital structure. A $100 million project utilizing 49% of WIFIA debt can expect to see a net present value savings of around $13.5 million when compared to a normal $100 million project financed solely with municipal bonds, by a municipal bond. And now when we co-finance WIFIA and SRF debt, we co-finance with SRF debt, the savings pop even more, with an estimated savings of around $25 million. And that increase in savings is due not so much to the repayment schedule of the SRF debt, but primarily to the interest rate benefits of the SRF debt. So we talked a lot about flexibilities, but how exactly are we flexible with borrowers? First, we are a very patient lender. WIFIA borrowers have up to 35 years post-substantial completion to pay back the debt. Additionally, repayments, both principal and interest, may be deferred for an additional 5 years post-substantial completion of the project. Lastly, the repayment amounts can be tailored around existing debt. As other debt rolls off the books, WIFIA principal payments may be increased. And this allows for borrowers to maintain an adequate coverage ratio while existing debt is amortizing. Disbursements can track incurred expenses, allowing borrowers to minimize capitalized interest during the construction period. Additionally, these disbursements may be made at no additional cost to the borrower. A WIFIA bond is callable. In the event that the borrower does find a cheaper, more flexible source of financing, I really don't foresee this being the case, but in the unlikely event that it does happen, the borrower does have the ability to prepay the WIFIA debt and take it out. And there is no cost associated with doing that. And finally, we have lien priority. WIFIA is able to be subordinate to senior project and non-project related transactions, debt. This helps the borrower attract new investors and/or maintain strong coverage ratios with existing lenders. So let's take a look at some visual examples that we can help drive home some of these benefits we've discussed. Here we have a side-by-side timeline of a typical bond issue and WIFIA debt. In this scenario, disbursements for both funding sources happen in year 1. And you can see that with the bond issue, interest payments begin immediately. Now we advance to year 3 when the project is completed, but WIFIA interest and principal continues to be deferred while the bond debt receives interest-only payments still. Now let's go further down the timeline. In year 8, after the 5-year deferral, WIFIA debt service begins. That's principal and interest payments. Also in year 8, the bond principal payments begin. So after year 8, we have a level debt service for both sources of debt. But there is one other key difference here. WIFIA's tenor is 35 years post-substantial completion, while the bond has a total tenor of 30 years. So on an annual basis, you would expect to see a sizably lower debt service amount for the WIFIA debt after year 8 when compared with the bond's debt service. In this next graphic, we take a look at WIFIA's disbursement benefits. On the top, we have a typical bond issue, while on the bottom, we have WIFIA. Same transaction, just different sources of financing. Now, with the bond, the borrower has to draw the full amount immediately post-financial close, forcing the borrower to accrue interest on the full balance of that bond issue. Now, with WIFIA, you see that disbursements are tracking expenses. So the borrower is submitting invoices to us for these various expenses as they occur through the 5-year construction period. And by doing this, the borrower is significantly reducing the amount of capitalized interest they're accruing. They're only capitalizing interest on the dispersed amounts. One of our most complex WIFIA benefits is our ability to be subordinate to other project and non-project debt. What exactly does this mean, and how does it benefit the borrower? Well, think of borrower debt as being in two buckets. Debt that is being used for the WIFIA supported project and other existing debt on the balance sheet. So WIFIA supported project debt and other existing debt on the balance sheet. Those are your two buckets. Now, WIFIA can be subordinated to both of these forms of debt. And what that does is it allows borrowers to preserve their senior lien so they may attract creditors and obtain lower cost financing and possibly better loan terms when those creditors come in on the senior lien. Now, the reason we differentiate between project and non-project debt is this. Now, during a bankruptcy-related event, WIFIA will spring to parity with the senior project debt. However, we do not spring to parity with other existing non-project debt, other debt on the balance sheet that's not supporting the WIFIA supported project. And that's pretty confusing. So let's take another look at this benefit and try to drive home what this benefit really entails. This time with the graphic. Here we have a typical flow of funds. We have rate revenues that are flowing to O&M expenses, then to the existing senior lien, and then to the senior project debt on the second lien, and then finally to the WIFIA project debt. And that's on the left-hand side. So let's figure out what happens during a bankruptcy-related event. We switch over to the right-hand side. And what you see is that the WIFIA debt is springing to parity with the project-related debt on the second lien. It does not spring to parity. It does not spring to the level of the existing senior lien. So those senior borrowers, you see them in the dark blue there, retain their priority. Now, let's walk through some case studies and show how many of these WIFIA flexibilities may be incorporated into your loan. Utility A has existing debt. So we have 4 case studies. The first one is Utility A. They have existing debt, and what they want to do is they want to smooth out their annual debt service. The second utility is Utility B. They need to raise rates in order to meet debt service obligations, but they want rates to be phased in over time. Utility C wants to simply reduce the financing costs associated with the project. And Utility D, the last one, is interested in increasing their debt capacity by making WIFIA subordinate to senior lenders. So Utility A. Utility A is a very creditworthy borrower, and they have been issuing bonds on a pretty regular basis. They have additional debt capacity, but because of all these issuances, they now have a repayment schedule that is very lumpy. And what Utility A wants to do is they want to use WIFIA's flexible repayment schedule to help level their annual payments. They also want the benefit of low interest debt. So here's Utility A's repayment schedule. You can see that there are various bond issuances in different colors. They have 4 different bonds with different repayment schedules, and this is causing debt service to be lumpy. And in some years, take for instance 2020, debt service is actually exceeding rate revenues. So we definitely have a problem in this scenario. So how does WIFIA help in this scenario? Well, WIFIA has a tremendous amount of flexibility when it comes to the repayment schedule. And in this case, WIFIA repayments are sculpted around existing debt, allowing the total debt service to stay flat through the life of the loan. So we never breach rate revenues, and there is a flat debt service that the borrower can more easily manage. Utility B. This utility's current revenues can't support a bond issue, so they have no choice but to raise rates. They would like WIFIA to slowly ramp up over time, so there is less pressure placed on revenues and customers in the early years. They also want low-cost financing that the WIFIA program offers. Now, with a typical bond issue, debt service is going to commence soon after financial close. So here we see rate revenues needing to increase from $2 million to over $3 million pretty immediately. And getting approval for such an immediate and large rate increase, it could be difficult. Additionally, the ratepayers may not be so accepting of such a large spike in their utility bills, in their utility bill. Now with WIFIA, the utility does not need to worry about debt service increases through the construction period and the 5-year deferral period. This gives them ample time to obtain necessary rate increase approvals, as well as to socialize rate changes with the public. Additionally, after the deferral periods, WIFIA debt service can be slowly increased through the life of the loan, allowing utilities to phase in their rate increases. And this gives ratepayers time to adjust more gradually to these increases. Okay, Utility C. Think of Utility C as a very large, credit-worthy borrower. They have adequate debt capacity. They have no issue starting repayment immediately. They simply want to achieve reduced financing costs with via WIFIA. So for these folks, there is no deferral period or tailored debt service schedule. They simply have level amortization. But what this does is it allows them to obtain a lower weighted average life for the loan. And as we know, that lower weighted average life will allow them to obtain a pretty attractive WIFIA interest rate. As borrowers pay, let's explain this in more detail. As borrowers pay more principal in earlier years, they're not backloading their principal payments, their weighted average life for the loan decreases. So a WIFIA loan that extends 35 years post substantial completion, let's say around 40 years from first disbursement to maturity, would have a weighted average life of around 20.68 years, and therefore an interest rate of around 2.71%. That is significantly lower than the 30-year Treasury rate, despite the WIFIA's tenor from first disbursement to maturity being around 40 years. So for our last example, we have Utility D. Utility D wants to issue debt for the project, but they have insufficient capacity on their senior lien. The project is $500 million, and their senior lien capacity is $200 million. However, they would be able to finance the project if they could utilize their junior lien capacity. So in this graphic, we see on the left-hand side that additional senior lien capacity is limited to $200 million. However, WIFIA can be flexible in terms of our lien priority. We can come in on a junior lien. So on the right side, we see the junior lien capacity being utilized by the WIFIA debt. And in this scenario, the borrower is able to obtain the needed funding to finance the project. Now, those were a lot of benefits to cover. Therefore, I'm going to do a quick recap. The key takeaways, WIFIA offers a very low interest rate, and we use the weighted average life of the loan, the average amount of time it takes for a dollar of principal to be paid, and we use that weighted average life and we match it to a treasury bond of similar maturity to generate our interest rate. WIFIA is very flexible when it comes to tailoring the repayment schedule. Payments may be deferred during construction and up to 5 years post-substantial completion. Borrowers may preserve senior lien capacity by making WIFIA subordinate to existing debt and project-related debt. And this allows borrowers to attract other lenders and potentially obtain more attractive terms with these lenders. WIFIA can offer a tailored repayment schedule to borrowers. Debt service payments may be tailored around existing debt and ramped up over time. This helps smooth total debt service on an annual basis, and it also gives customers time, ratepayers time, to adjust to rate increases. The WIFIA repayment schedule also allows for significant backloading of principal payments. WIFIA understands that high capital expenditures and other expenses may make debt service difficult in early years. Therefore, we allow borrowers to backload principal. And this does two things, really. It allows borrowers to begin substantial payments at, I should be very clear about this, it allows borrowers to begin substantial repayment at times when cash balances are more stable. And it also allows borrowers to save on a net present value basis. Paying principal in out years may generate a sizable net present value, NPV, savings. And it really depends on the borrower's cost of capital. So this is also a key benefit of this type of approach. Lastly, we are a very flexible federal credit program. We try our best to accommodate borrowers where we can, and the fact that we are in the capital structure can sometimes provide a lot of confidence to other lenders who want to enter into the transaction. So that is also another benefit of doing business with us. So with that, I'm going to hand it back off to Jorianne to go over resources and questions.
Okay, thanks, Amit. Now, before I walk through the final review slides, I just want to remind you to send in your questions for my colleagues. I'm just going to have a couple more slides and we'll get to the questions. I wanted to make sure that everyone is aware that the program has a number of resources available to prospective borrowers. We will be hosting one more in-person outreach session on January 17th in Washington, D.C. We're also hosting part 3 of this webinar series next Wednesday. Finally, following the release of the Notice of Funding Availability, we will host webinars to walk through that notice and discuss specifics of the FY18 selection round. So please stay tuned for announcements on those future webinars yet to come. In addition, our website includes a lot of general information that might be of use to prospective borrowers. We have information on the program and application materials, as well as information on how to apply. We will be sending out a PDF of today's presentation to all of those in attendance in the next few days. Finally, I just wanted to share the contact information for the entire team. If you have any questions, please feel free to reach out to us. We are here to help. We can also be contacted through our general mailbox. That's wifia@epa.gov. If you are interested in receiving the most up-to-date announcements, please sign up to receive our news. And now I will go to questions from the audience. I see we have a few ready to go. So Kevin, do you want to join me? And I'll just start running through some of these.
Sure.
All right, the first question. I thought it was standard policy for rating agencies not to release a preliminary rating. Are they flexible to make an exception for WIFIA?
So when I spoke earlier about WIFIA's rating requirements, there are two rating requirements. They're in our statute. There's the preliminary rating requirement, which we require when a project sponsor submits an application, and then the two final ratings at financial close. We do not require that the preliminary rating be a public rating. And so to answer your question, there's no need for exceptions for WIFIA because we do not require that preliminary rating to be public. However, the two final ratings must be. To the extent that the preliminary rating is public, obviously that's good, and we don't really need to say much more about that. So hopefully that answers your question, Donald.
Okay, the next question is, are the details that support the savings conclusions shown on slide 25 available? And I was going to actually go ahead and answer that question. Sorry, guys. Sometimes I take moderator's prerogative and answer the question. We do not have those calculations posted on our website right now. However, if you're very interested in it, I would recommend you follow up with Amit after this presentation, and my guess is that he would be more than happy to walk you through those. All right, next question. For Utility A, can you explain more in depth of how WIFIA can help with smoothing out the lumpy payment schedule?
Yeah, so with Utility A, what was happening here is that you had a lot of existing debt on the balance sheet, and the repayment schedules were such that, you know, in some years the debt service was stacking for multiple debt. In some years, some of that debt had rolled off the books, and the repayment was simply for one bond, perhaps. So it was kind of lumpy. Now, in terms of how you can smooth it out, well, with WIFIA, your debt service amounts, it's not like a straight line. It's not a typical level debt service. We can adjust the principal amount, you know, based off of your debt service levels. So if there are periods in your through the life during the loan where we feel you will be crunched in terms of how much cash will be available to service debt, we can work with you to reduce the principal payment amount for the WIFIA loan. And that will allow you to kind of level out your total debt service through the life of the WIFIA loan.
Okay, Kevin, I'm going to do a couple for you. First question, does EPA require a certain percentage of the total WIFIA loan to be set aside until the end of the project? This would be similar to a bond reserve fund requirement.
That's a great question. The statute which guides or is our law does not specify specifically what sort of reserve requirements are required for individual loans. As I mentioned earlier, EPA requires that a project be creditworthy. And to the extent that in our underwriting process, we feel in order to guarantee a reasonable likelihood of repayment that something such as a reserve fund is necessary, we will incorporate it into the terms of our loan agreement. To the extent that the project structure is highly creditworthy, for example, a AAA general obligation, in most instances, we will not require such a reserve. So it really depends on the credit quality and the structure of the individual transaction.
Okay, great, Kevin, thank you. And I'll have you stay up for the next question as well. This is a long one, so I'm going to try to paraphrase it somewhat. The question is about the slide that shows WIFIA springing to parity in a bankruptcy-related event. And so the first question is, on that slide, would the co-finance, you know, the co-financing, the senior debt be shown in the place which has a blank? Then a follow-up part to that question, can you talk a little bit about the circumstances besides bankruptcy, which would lead to a springing of the WIFIA loan, a bankruptcy-related event? And are there any places that someone could find out a little bit more about what those terms, when that might happen?
Sure. So on that slide, the project sponsor in this instance has an ongoing capital program that they have funded out of an existing senior lien. They're looking to construct a new project that's relatively big, and they don't have capacity on their senior lien, so they've created a new structure below their existing bondholders to fund that project. And so in that instance, on that chart, WIFIA is on a third lien, and the senior project debt is on a second lien. And so, to clarify, in a bankruptcy-related event, which will be defined by our loan agreement, but in most instances will be a missed payment to WIFIA, so payment of our debt service, we will spring to parity in that we have the same rights as the senior lender for the project. So in a bankruptcy-related event, which we define, we will then have all of the rights and remedies that the senior lender has, and we will have the same claim over the cash flows that fall to that second lien as the other project obligations. So once we, in essence, are parity with them, that third lien which we sat at when we initially structured the project's obligations is empty, because WIFIA is now recognized as a second lien bondholder. And I think that to answer the second half of that question about how someone might find some more information about the scenarios in which a bankruptcy-related event would occur, we at the WIFIA Credit Program are in the final stages of creating a WIFIA template term sheet and loan agreement for public system borrowers, which we will be releasing hopefully in January, which will provide potential project sponsors the ability to understand how a loan agreement and term sheet would look, and will specify what we expect a bankruptcy-related event to look like.
Thanks, Kevin. Amit, can you take the next question, which is about fees? Someone is asking about fees on a small issue, such as a loan between 20 and 50 million. In that instance, would WIFIA be advantageous compared to the market?
Well, you're getting a little bit closer, because in my slides I said 250 to 350K would be the fees we're estimating currently. So 1 to 2%, you're talking about $500,000 potentially on the high end of your scale there. So still, we'd be a little bit cheaper. But if your project was $20 million, I think you'd be pretty much level with the cost of our fees. So level or better.
And I would just encourage anyone who has specific questions, if you want to follow up with either Kevin or Amit to talk through, a particular project, they are definitely available to do that. Next question: would a WIFIA borrower be able to use all of the WIFIA proceeds first before the other 51% of the financing package is utilized?
So this is Kevin. I think the answer to that question, and maybe I sound a bit like a broken record, is it really depends on the credit quality of the overall structure. And so WIFIA is flexible, but it needs to ensure that the government will see a project that it is financing through to completion and operations, and so that the benefits that we are supporting out of the project are realized by the general public. And so to answer that question, In most instances, with the credit quality that we saw in our first round and that we expect to see in hopefully subsequent rounds of letters of interest, a project sponsor could use WIFIA funding first and then use, for example, bond proceeds or grants as they become available in subsequent years to fund the other remaining portion of the project. But we're very flexible in terms of when a project sponsor uses WIFIA proceeds. If a project sponsor is going to issue bonds and then spend them down, then use WIFIA at the end of the project in order to save, as Amit indicated, the carrying cost that a bond has and WIFIA doesn't, that's another funding structure that we could easily support. But again, at the end of the day, we have to have a reasonable assurance at financial close and throughout the transaction that the project is fully funded and that a project sponsor has access to the resources to complete the project.
Great, thanks, Kevin. Yeah, I was going to say, why don't you stay here and let's do a question about disbursements. The questioner is asking what the process for disbursement review and approval will include, and then specifically on that, is there a frequency limit to disbursements? For example, would we only disperse, once a month or what have you?
That's a great question. So I will start with the second half of that question first in terms of frequency. So we intend to limit a borrower's ability to draw to once a month. So no more frequently than once a month can a project sponsor submit a requisition to EPA to pay for eligible project costs that have been incurred. We obviously are willing to disperse less frequently, and there may be instances where WIFIA financing will be used to pay off interim construction financing, in that the WIFIA proceeds will be used at a single disbursement at the end to pay off that construction financing. So I think the takeaway is no more than once a month, but as infrequent as once at the end of the project to pay off that interim construction financing. And in terms of the review and approval process, EPA at every draw will ensure that the project is fully funded. We will do a process to ensure that the project is meeting all of its obligations under the loan agreement, and that includes all of the federal cross-cutting requirements such as Davis-Bacon, Buy America, American Iron and Steel requirements, etc., and do a review of the invoices that substantiate that draw to verify that the costs that you are submitting to us for reimbursement are eligible, reasonable, allocable, and all of the requirements that attach to federal dollars. And our hope, or our expectation, is that a borrower will be able to submit a requisition on, for example, the 1st of the month and receive payment from EPA on the 15th, so 2 weeks later.
That's great. Thanks, Kevin. I'm going to encourage everyone to continue to submit questions. We have a little bit time left allocated to this webinar series, and only a couple more questions showing on our screen. So if you've got a burning one that you're just sort of waiting to put up there, please go ahead and submit it to us. We are very happy to take your questions. The next one that we're going to tackle is about the rating letter, and the question is a rating needed from both the borrower and the sponsor? Kevin?
That's a great question. And so let me clarify that the rating requirement that we have in our statute is on the credit structure that WIFIA will be entering into. So to the extent that the sponsor is creating a credit structure that has a different security and priority than potentially itself. So let's say a water and sewer authority is creating a new special purpose public corporation to fund an individual project, and the cash flows to fall into that corporation come after the operations and maintenance and current debt service of that system. WIFIA will require a rating on the security structure itself. So obviously the borrower will be rated, but we need to have a rating on the security structure.
That was a great answer, Kevin. It's a little bit of a complicated question, but I think that was well explained. We have a question about American iron and steel waivers, and I will just sort of quickly say that the administration wants to ensure that products that are used for federal projects are made in America, especially iron and steel. And so, you know, we strongly encourage you to try to ensure that your products are AIS compliant. If they're not, please circle back with the please circle back with us within the WIFIA program, or with our colleagues who run AIS within the Water Infrastructure Division. And then the last question that we have on screen, so we may end up finishing this webinar a little bit early. Kevin, I'll give this one to you, is does a project have to be shovel ready for WIFIA?
So that's an interesting question. I know that the term shovel ready became popular in the stimulus bill back in 2009, and I think that our statute outlines a number of criteria that make a project eligible, and in that list of criteria, pre-development and preliminary planning, right-of-way acquisition, all of those costs are typically eligible for reimbursement. However, I would say that those costs are typically incurred by a project sponsor to get the project to a point at which it's ready to seek financing, such as WIFIA, to support the project. And so while the answer is that the project doesn't, from an eligibility perspective, need to be ready to proceed to construction immediately, we have seen that project sponsors aren't ready to submit a full plan of finance until their projects, in essence, are ready to go. And so I think just from a ripeness perspective, we will continue to see that project sponsors are submitting projects that are, I would say, and correct me if I'm wrong, Jorianne, no more than a year before they're ready to proceed to active construction. But to the extent that you have a question about where your project is in the development process and when you think you should come in with a letter of interest for WIFIA credit assistance, you should definitely reach out to us to discuss that, so that you come in when the project's ripe and we can underwrite the credit in a way that makes sense for both of us.
All right. Thank you, Kevin and Amit. I think that was great. That was the last of our questions, so thank you to the audience. We hope you have found this information useful, that you're excited about some of the benefits that WIFIA financing may be able to provide your projects, and that we see some of your projects in our next funding round.